right, welcome everybody. Shane Carter here, Hampshire Capital. Along with me, as always, our VP of Investor Relations, Eddie Austin. Good afternoon,
Hello,
Eddie.
Shane. How are you? Man, I'm doing great. How about you?
I'm doing great this beautiful day, man. And so our topic today, we decided we were going to discuss was investor returns in this new capital market condition, elevated interest rate environment that we're in. Here we are in 2023. Kind of in Q2 of 2023, what are we seeing? What are we doing? And where are we investing? And what are good expected returns for investors to be considering in this environment?
I think this is a subject that we definitely want to touch on. And as we discussed before we started the recording, it is a new time. And, the old times of, grabbing hold of loans that were low interest rates that created returns of upwards of 24, 25% IRRs, 3x returns on their capital, is probably not going to be the new norm, unfortunately. And I think investors, especially LPs, may have to see a little bit different side, as if you are advertised as a very high rate of return, it's going to be a higher risk property, in my opinion. So we could probably still find opportunities to buy properties that were 3x multiples, but there's going to be a lot of risk involved in getting the property back online, because those high returns are a heavy lift property. We probably bought that thing extremely cheap and put a bunch of money into rehab. And let's be honest, if we're a 70, 30, 8% preferred return company, those return at 8 pref is not going to start the first year, maybe even not the second year. That's just going to accrue, So you might get a 3x multiple, but on a 5-year hold, you're probably not going to get any money until year 2. So you only got 3 years of returns.
Yeah, you bring up an interesting point. And, what I would ask investors to think about and consider are, what are your key metrics that you want to key in on, right? We have a cash on cash metric. We have an internal rate of return metric. We have an equity multiple metric. And frequently in value add, middle market multifamily deals like we do, there is an inverse proportional relationship in a lot of those. What do I mean by that? Well, illustrating your point exactly. You can have a low cash on cash deal that has a very high equity multiple, right? So you need to know as an investor, are you willing to forego some of those quarterly pref payments, especially in the first, year, maybe year and a half, so that you can realize a larger equity multiple in a typical 5-year horizon play? Or inversely, is the quarterly pref payment or quarterly payments more important to you, and you're willing to forego a bigger equity multiple down the line because you're more keyed in, or it's more important to you to have those quarterly pref payments? There's no right or wrong answer here. That's just something important that investors should know for themselves and should be able to identify in their own, wherever they are in their investing sort of lifespan, and what is important to them in terms of how these alternative investments sit in their overall portfolio.
Absolutely. And if an investor wants a monthly return, there's definitely funds out there that are diversified and have a good life cycle. They could get a monthly return. And there's funds out there that they have no preferred return, and there's just a straight waterfall, and that's just paid every quarter. So, again, it really, like for us, when we're looking at a new investor that comes aboard, we ask questions, right? What is it you're looking for? Are we trying to create generational wealth? Is it income replacement? And are you wanting a tax shelter to harbor your money? What are these different things that you're looking for? So we can figure out what kind of fund we want to put them in.
Yeah.
We got opportunities.
That's exactly right. And we can help them, get out of their stagnant 401ks, transfer them into self-directed IRAs where they can really use that money to invest a little more wisely. We can help them understand deferred sales trust if they have a taxable event, or they have sale of a business or otherwise earned or realized income that is going to be heavily taxed relative to capital gains or other estate taxes. We can set them up with the right professionals to do that as well. And really, it's just about we're digging into our individual investors and understanding what their needs are and objectives are, and helping them align with the right products and relationships that are going to help them the most, whether or not that's with anything we're doing or not.
Right. And guys, just to put this in a little bit more context, the deferred sales trust, the DST, after learning more about it, I see no absolute immediate reason, and Shane, correct me if I'm wrong, to do a 1031.
Yeah.
I see no reason to do a 1031. There's time restraints. You do not have the ability to move capital where you want to go. You don't have a controlling component to that as much as you believe. And it's very limiting. And marrying a DST to one of your sales is, and you need to do that before selling a business or selling a property, but that is the ultimate way to preserve your wealth.
Yeah, look, let's not go too deep. That's a whole other episode we're going to create. 100%. But look, I don't disagree with you at all, right? I fully believe in that as a technique. So look, back to the investor returns. Let's outline, so look, the last 3-4 years or so in this big uprising market, low interest rate environment, tons of capital being injected in, sort of false profits being obtained relative to, post-COVID cycle run-ups. Investors were getting, crazy, 20, 30% IRRs and 2.5, 3x equity multiples. And, those returns are not normal. And they're not what is generally something that should be expected of our industry. And I think that this 2023 reset, sort of late 22, rising interest rate environment, 2023 reset is going to show us that this is now we're in a back to basics market condition for middle market multifamily, value add multifamily, where you've got it's what I like to call blocking and tackling, right? It's just fundamentals, it's execution, and it's in our case, truly fundamentally increasing value in a property and forcing appreciation, not relying upon 10, 15, 20% rent growth and market rent growth conditions.
Right.
No, we're expecting 2.5%, 3% rent growth, right? And for years, that's what we're expecting for the next 3 years, before things would potentially change in a more favorable condition. So with all of that comes, sellers need to have a different expectation of what valuations are. We're seeing properties that are 20, 25%, 30, 33%, 35% less than what they were worth 18 months ago, right? 12 months ago.
Let's think about it. All this stuff happened. If we bought a property in 2015 and we had done our conservative underwriting, and we were going to be, a 1.9 to 2.0 equity multiple, say cash on, or the IRR was 18%. Well, if that property ended up, we were exiting that property in 5 years and we exited that property in 2020, our appreciation schedule would have been way off the charts in the positive manner, because we would have sold that property for a price we would have never fathomed. And when we sell a property for 2 times our business plan, that's some crazy returns. And I think a lot of investors got used to them returns, and now they're just kind of like, well, I'm waiting for that next 25% IRR and a 3 and 4x multiple, and it's just not there, guys.
No.
And if it is, your money's at risk. It really is.
Yeah, absolutely. So let's lay out what I think is what we underwrite to today, which is a typical 5-year hold, no refi, right? If we get refi, then that obviously pumps the numbers up and makes them look better because we're returning more capital sooner, raises the IRR, et cetera. But our analysis is really based on a 5-year hold, no refi, straight economics. And what we're underwriting to is basically a typical sort of what we call a mid-teen IRR. So 14, 15, 16%, that's a win. right? If
Right.
we're
Yeah.
getting those returns on an asset, on a stable asset that is, mid 80s to, early 2000s vintage, value add, kind of, light to moderate, that's a solid play. It's a great risk adjusted play. We're limiting our downside risk, and we're really only selecting properties that we have a good basis or have really good assumable debt, or have, and additionally, not or, but and have a clear rent growth story where they're sitting lower in the rent comps, and there's a clear path to getting to a rent growth and a pro forma rent that's already proven in the marketplace. There's a lot of markets right now where we're seeing rents go down, but where are we seeing that? Well, we're seeing that in some of the A-class product. We're seeing that in markets where they push the rent too high, right? They were getting beyond that median household income and what that sort of 3x income for affordability quotient would be for the rents, and they were pushing way beyond that, right? They were pushing a 2.5x, 2x. It's just not sustainable. It's not real. And now the pullback is really pulling back from what is inappropriate to where reality is. And now we're back to reality, which is a much healthier state to be in as a market.
Right. Well, this to give you a good laugh. I had a guy was on a Zoom call with me, and he goes, Eddie, so what's the key indicators that takes you to buy a piece of property? When do you just know that you're going to buy that piece of property? And he goes, I'm looking for an 8% cash on, or I'm looking for an 8 cap and 10% cash on cash. So we don't buy D properties.
Whew. Right. Yeah. We don't buy in the hood. Sorry.
He said, what do you mean D property? And I said, those are D returns. And I said, and those rents are, you bought that thing for pennies, and rent's $400 a month. I don't buy those properties.
Yeah.
There's a great deal of risk. The property could get burned down. It's not a good place. And
look, as I've experienced in my career, you have as well. I know it's just a tenant base that's real difficult to change, to gentrify, and it comes with a whole slew of headaches.
It does. It really does.
It's a lot of headaches.
Your property manager, asset management team, you're going to get calls all the time. You will be managing the 3 Ts.
You will. Yeah. Yeah. And so, based on that too, like you said, there's too much risk. There's not enough reward for that type of risk. I'd rather personally, as a passive investor, invest and get a more moderate, reasonable return with a much better risk profile. Now, I think the thing to point out too is, look, anytime you're looking or analyzing an investment, it has to be compared to what, right? Where else are you going to invest your money? Your investment, your money needs to grow. You need a place to invest it. Where is it safe, and where is it going to grow at a reasonable, moderate rate? And so we're stocks, bonds, equity, right? I think the returns that we're talking about, 14, 15%, 16%, sort of on a good deal, those are still double what you're generally going to see in a stock or equity scenario. And there's a perceived risk there. Well, the stocks are more stable. Are they? Are they really? When you look at a general 7-year cycle for stocks and bond, equities, they do generally appreciate, about 7% or so over that general 7-year time frame. In between of which, obviously, there's a ton of ups and downs. But if you just forget about all those ups and downs and hold it for the long period, you're gonna average about 7% for gains on your money, right? So we're talking about
an asset.
What's that?
Is a stock an asset though?
Yeah, questionable, right? I mean, I think we covered that on another episode in terms of the ability to produce leverage to acquire a stock, right, and versus a physical asset, commercial asset, and what are your shares in a commercial asset? Sort of, that equity.
I can bring it into focus. So usually what I say is we invest in addresses, not IP addresses.
Yeah, that's a good one. Yeah.
And you know, I got one more. I think you know, the higher the returns, the higher probability you're going to call the SEC,
Mm.
and the lower the returns, the less chance you're going to need the SEC
Yeah.
to step in and do something.
Yeah.
And I feel like that because I get sent a lot of properties, a lot of opportunities. People want me to raise money for them. And when I start seeing underwriting models, I'm like, look, guys, a 10% rent appreciation schedule is not logical. I know that you might get that, you know, in the first few months. You might get it the first year, but that's not something that's going to last. You're going to have move-ins, move-outs, wear and tear on the property, and it's just not logical. You know, so don't take that method. You know, do a nice 3% rent growth, and you know for a fact that your vacancy is going to stay good. Those returns are going to be consistent. You know, it's all consistency, right?
That's
to
it.
get a good return is consistency. Consistently hitting an 8% preferred return that you can actually pay to an investor, and a waterfall that has a good return in it from occupancy being high that you can actually return a lot of capital. And doing that on a consistent basis over your 48 months.
Yep, that's exactly right. And so yeah, let's talk real quick about, you know, what those cash on cash and equity multiples look like, because again, as I discussed earlier, those are generally speaking inversely related, right? If you have a higher cash on cash, especially right out of the gate, you shouldn't expect a higher equity multiple down the line. Inversely, if you're expecting a higher equity multiple, then you're likely okay with having a lower cash on cash metric throughout the life cycle of the investment. So what are appropriate cash on cash metrics and equity multiples on deals that we're currently underwriting and looking at and making LOI offers on? Well, they look like year one cash on cash is probably in that 4 to 5% range. And that it is growing over years and through years 2 and 3 to get to that 8%, an 8% plus range to start to pay off some of the accrued. But in general, we're seeing, again, a typical 5-year hold, no refi, that is averaging, you know, pretty much just over an 8% cash on cash. So you're getting those payments, but you're sort of basically catching up and accruing some of those pref payments all the way to the end of the exit.
Right.
Your equity multiple is probably going to be more in the 1.6 to 1.8 range. 1.75 sort of being a typical target to hit for an equity multiple on a standard 5-year hold. And I think that's appropriate. So, you know, the days of the 2.5x, 3x, you know, those just were outsized returns at a very specific time in the market that was wonderful, but shouldn't be expected in today's market conditions.
No, like I said, I mean, the higher the returns, the more likely you're going to need to have the SEC to step in and hey, I lost my money in this deal. And can you do anything about it? The SEC is going to say, well, did they explain the risk of investing? They did. Well, they did everything right. And ultimately, you lost your money.
Well, look, the number one rule for anyone who is a steward of capital is protect the principal, right? Mm-hmm. Never lose principal. I think that's Warren Buffett's first rule of investing.
Yeah. Rule number 1, never lose money.
Never lose the principal. Right.
Rule number 2 is refer to rule number 1.
That's right. Yeah. And so, you know, the higher you chase those returns, unfortunately, the greater risk you uncover to potentially lose principal. Right. Yeah. And the lower return, not necessarily lower, but the more appropriately sized returns. And so everything we're talking about is mostly, you know, B class middle market value add. Mm-hmm. If we're talking about A class, stabilized sort of 2018 to 2023 product, look, I think those numbers are even different, right? I think you're, you're in a similar maybe cash on cash profile, maybe a little higher. Maybe your year one cash on cash is closer to 6 or 7. And you're getting to an 8.5%, 9% cash on cash, maybe even 10 towards the end of the life cycle of the investment. But again, your equity multiple is probably going to be in that 1.5, 1.4, 1.5, 1.6 range. Your IRR is probably going to be more like 12, 13, 14. But you have a different risk profile, right? You have a nicer asset. You have a different resident base. You have less deferred maintenance. You have less sort of headaches. And so you have a less risk investment for those returns.
Right.
So folks just
And you
need to
don't have,
understand where their investment thesis sits in that profile.
Right. And with a Class A, I mean, there's not many amenities you're going to add to the property, so the value add play is a lot smaller. You know,
Yeah.
You're not going to go in a Class A property and probably do a bunch of renovations.
That's right.
You know, you're not going to be spending a bunch of money on a new roof and everything else. So.
Yeah. It's either a light value add, or it's what we call a coupon clipping, right? Where it's really just about that. You're buying cash flow. You're buying that quarterly pref payment.
Right. Exactly.
And you're preserving your principal in the process and growing it, at a moderate / appropriate level in an asset-backed investment.
Yeah, absolutely. No, I couldn't agree more, man. I think this is something we needed to do, and it's definitely something that needs to be in the market more. Is just what are expectations of LP investors and what does it look like? And then hopefully even some other sponsors might watch this video and say, you know what, maybe I need to control my underwriting a little bit better, be more conservative. And I would tell anyone raising capital, anyone that's a fiduciary to other people's money, be responsible and be an under-promise, over-deliver company. Be that person that 10 years from now, everybody still knows, likes, and trusts Hampshire Capital, Eddie and Shane, and everybody on the team, because we just consistently did the right thing.
Absolutely, man. That's well said. Well said. So yeah, let's wrap up. I think that was a great episode.
Yes.
I think we covered a lot of good topics. Hopefully, folks found value in that. If you did, please like and subscribe so we can keep producing more and more of this content that hopefully helps folks out there.
Absolutely. It's the name of the game.
All right, buddy. We'll see you on the next one.
Yes. Thank you so much.